Let's move on to the next section of life insurance, the types of life policies. There are many types of life insurance policies, all of which are designed to serve different needs. This section will introduce you to these various policies, explaining how they function, how they are paid, and the needs best served by each one. We'll begin by defining the general categories of life insurance markets before moving on to the different types of policies, premium structures, and needs that they serve. Some of the major advantages of life insurance are there's no public record of the death benefit amount or to whom it's payable. In most cases, the death benefit proceeds are not subject to federal income taxes. Life insurance proceeds are not part of the probate estate unless the estate is named as the beneficiary of the policy. Therefore, the proceeds can be passed to the beneficiary without the expensive delay or uncertainty caused by administration of an estate. And the policies containing cash value grow tax deferred, and the policies containing cash value, the policy cash values can be borrowed at a low net cost. Let's dive into the types of insurance policies. There are participating and non-participating policies. A traditional participating, sometimes known as PAR policy, is any policy that allows the policy owners to share in the insurer's profits by earning a dividend. Dividends will be discussed later in another section. The insurers are very conservative when determining the premium to be charged on a policy. If the insurance company's experience is more favorable than originally assumed, then excess premium is returned to the policy owner as a non-taxable dividend. The policy owner is given the option on how to use that dividend. A non-participating policy, also known as non-par, means the policy or policy owner does not earn dividends. In a non-participating policy, if the insurer's experience is more favorable than originally assumed with respect to the premium pricing computations, the premiums in excess of the amount needed to pay the insurance company's obligations add to the insurance company's profit or surplus. If the insurer is a stock insurance company, this profit is paid to the stockholders, not the policyholders, as a taxable dividend since it was a return of profit. Traditionally, a mutual insurer was considered a participating insurer, and a stock insurer was considered a non-participating insurer. However, today, both mutual and stock insurers issue participating and non-participating policies. For the test, remember that a participating policyholders share the insured's profit by receiving non-taxable dividends, and non-participating policies, policy owners do not share in the insurance company profits. For the test, a mutual insurer is a participating insurer, and a stock insurer is a non-participating insurer. Let's now talk about individual ordinary life policies. Originally, ordinary life market policies were sold to individuals that were not low income and could afford larger death benefits and did not require an agent to pick up frequent premium payments. In the beginning, ordinary life policies had a death benefit of $1,000 or more, whereas industrial life had a death benefit of $1,000 or less. The majority of agents today sell ordinary life insurance policies. Some of the characteristics are a term used to describe individually owned life insurance policies is ordinary. It has larger face amounts. The premiums are paid monthly, quarterly, semi-annually, or annually by mail or deducted from a bank account. Individual policies are written. Evidence of insurability is required. It means you have to pass a medical exam. It needs more information than other forms of life insurance. It's the most expensive form of insurance to administer. Therefore, the insurer underwrites, issues, and bills for the policy, and there's a minimum grace period of 30 days. It consists of all forms of term, whole life, endowment, and flexible policies, and it does not consist of group insurance or industrial policies. Let's now talk about industrial or home service and group insurance. There are four distinct categories or markets for life insurance: credit life, industrial life, group life, and ordinary life. Credit, industrial, group, ordinary. CIGO, C-I-G-O. Though the test is currently only addressing three of these four markets, ordinary, industrial, and group, here's a brief overview of all the segments and the characteristics of each. Credit life pays off loan balances in the event of death of the borrower, either from an accident or from natural causes. It does not pay the loan payment if you're disabled. Credit health insurance pays the loan payment when disabled. A policy known as A&H pays the loan off if death was caused by an accident only and will pay the loan if disabled. Credit life insures lives of debtors for the benefit of the creditor, for the people making you the loan. It's purchased on an individual or group basis. It usually is decreasing term, however it can be level term. It cannot exceed the amount of the indebtedness or the loan itself. The creditor or lender is both the policy owner and the beneficiary. The creditor or the lender must apply insurance proceeds to discharge the loan, and the premiums are usually added to the loan installment payments. In other words, the customer pays additional amount to fund the credit life insurance. Life insurance coverage can be acquired by people who cannot obtain it in any other way through most credit life insurance. This is a form of group insurance associated with lenders for the purchase of automobiles, furniture, and other consumer durables, even homes. Let's now talk about industrial life. Industrial life insurance is characterized by comparatively small face amounts, such as $1,000 or less. Later on, $2,000 or less was common, with premiums collected on a weekly basis by the agent at the policy owner's home. Originally, these low-income workers were factory workers. Industrial insurance, or debit insurance, offers a way for individuals who cannot afford larger policies to obtain some measure of insurance. Quite often, it's marketed and purchased as burial insurance. Today, industrial insurance, or debit insurance, is sold by home service companies, and the agent is now called a home service agent. The policy face amounts are larger, $5,000 to $15,000, but the market is still the same. These types of policies are sold to low-income individuals and can still require the agent to personally collect the premium from the insured. The mortality rates are higher for industrial policies because the insureds tend to have higher than average health risks and poorer than average living standards. Originally, the policy characteristics were small individual policies issued to low-income workers, face amounts of $1,000 to $2,000 or less. The maximum aggregate in California for any one life was $10,000. Medical exams usually were not required, and frequent premium payments, weekly or monthly, were collected door to door by debit agents. And the policy is not required to have any cash value until the 5th year. There's no suicide clause, means suicide was not excluded, and the cost per unit of insurance is higher for an industrial policy than for an ordinary policy. Let's now talk about group life insurance. We'll be discussing group insurance in an upcoming section, but here's an overview. The basic principles of group insurance is that it provides insurance coverage for a number of people under a single contract. Though there are very many forms of groups, the most common is the employer-employee group. Group insurance will be discussed in greater detail in another section. The basic characteristics of group are: it has to have 2 or more employees. It originally required a true group, which was at least 10 employees, but now we can start a group with 2 employees. Has more liberal underwriting, meaning less information is required than individual policies, and usually no medical underwriting. Individual exams are not required. It's the least expensive administratively to administer by the insurance company because it's all on one contract. Usually it's annually renewable term insurance is the policy that's used. However, any ordinary individual type insurance policy can be sold on a group basis. The premiums can be paid entirely by the employer, non-contributory, or shared with the employee, contributory. Now let's talk about the general classes of life insurance and their uses. In order to understand the various types of insurance policies, we need to define a few terms. Cash value means the value of the accumulation of cash in a permanent policy, sometimes referred to as cash accumulation or just cash. Cash surrender value is the amount available should the policy owner surrender the contract before maturity. During the early policy years, the cash value is the reserve less a surrender charge. In later policy years, it usually equals or closely approximates the reserve value at the time of the surrender. Sometimes the test calls this using the initials CSV, cash surrender value. Endow. On endowment of a policy, the endowment of a policy is the point when the guaranteed cash value equals the original death benefit of the policy, and when that happens, it's said to have endowed. This is a feature of permanent policies, sometimes referred to as the maturity date. In other words, if you purchase a $100,000 life insurance policy and live long enough, the premiums will accumulate cash value inside the policy to equal $100,000. When that happens, it's said that the policy has endowed. Face amount, the amount of insurance provided by the terms of the contract. In life insurance, it is the death benefit. Sometimes it's referred to as the limit of liability. So face amount equals face value equals death benefit. Living benefits. This is a term given to the benefits that an insured can exercise in a policy containing cash value or accumulation. The living benefit consists of cash surrenders, loans, and non-forfeiture values. All of these terms relate to the cash value in the policy, and the terms just indicate what is being done with that cash value. Pure and permanent contracts. There are only two concepts that insurance policies fall into: pure protection contract and permanent contracts, sometimes referred to as permanent protection. Pure protection products provide for a death benefit only. There is no living benefit such as cash value. Permanent protection policies provide both a death benefit and a cash accumulation or living benefits. Let's talk about surrender charge. Some permanent policies, especially the newer flexible policies and annuities, levy a surrender charge for at least 10 years and some for as long as 15 years. It's an amount deducted from the surrender or cash value if the policy owner terminates the policy during its early years. As an example, would be if the policy contained a 10-year surrender penalty and the contract specifies an 8876543210 penalty structure. This means that if the policy owner surrenders the contract in the 6th year, any cash value in the policy would be charged a 4% penalty. In that structure, the first 2 years are 8 and 8, which means if you cancel in the first 2 years, you give up 8% of your contract value and only get back 92% of it. This is why permanent insurance and annuities are long-term planning vehicles. This is also known as a back-end charge. Traditional policies, sometimes referred to as ordinary life on the test, these policies have level premiums, level face amounts or death benefits, and fixed benefits that are determined at the time the policy is purchased, offering very little policy owner control. Traditional policies include term, whole life, and endowment contracts. These types of policies are considered by the policy owner to be inflexible but guaranteed contracts. Sometimes on the test, ordinary means policy sold to individuals, and it can also mean traditional whole life policies. Let's talk about flexible policies. Newer products that provide flexibility in either premiums, face amounts, and investment objectives. The main types of flexible policies available include adjustable life, universal life, variable life, and variable universal life. Before we get to those, let's define term. The two principal characteristics of term insurance are the insured must die for any payment or proceeds to be made, and two, by definition, the contract expires at the end of the term. Stated more specifically, a term life insurance policy promises to pay a death benefit to a beneficiary only if the insured dies during a specified period of time. It's for this very reason that term insurance is known as temporary protection. The contracts make no promise to pay anything if the insured lives beyond the specified term. Generally, no cash values are payable under a term life insurance contract. If the insured survives the specified term, the contract expires and provides no payment of any kind to the policy owner. However, all term products have a level premium. This means the term premium stays the same or fixed throughout the policy period. Keep in mind that term insurance, more than any other type insurance, is pure death protection with no lifetime or living benefits. Therefore, the two overriding considerations in the use of term insurance, regardless of the need, are: will death protection alone meet the need? And two, will the coverage last as long as the need? In short, with term, as with any other decision about the appropriate type of coverage, the product must match the problem. So what needs does term insurance meet? Term insurance would be a policy of choice in the following circumstances: when the need for life insurance is temporary, such as short-term debt; when the need for protection is high, but the insured's ability to pay is limited; when there are children still at home, there's a need for a high amount of protection; career changes, changes in indebtedness are other reasons for purchasing term insurance; to pay off a mortgage or a credit balance, or needs that are time sensitive, for example, loans that go for 5 years or 7 years. The following summarizes many of the characteristics of term insurance. It's also known as temporary protection. It insures for a stated period of time. The face amount is payable if death occurs within that specified time frame. There's no cash, loan, or other non-forfeiture options, no living benefits. It's considered pure protection. It will expire at the attained age or after a specified period of time, say 10 years or 20 years. Renewing is a characteristic of term insurance. Permanent policies do not renew, as they provide coverage for the insured's lifetime. Level premiums are fixed. They can't change. They can never be paid up. If you do not pay your term premium, then coverage stops. Their substantial death benefits can be purchased for initially low premium outlay in the early years. It can be issued as a policy or used as a rider, which gives term flexibility. Permanent policies cannot be used as riders. It can guarantee future insurability through renewable and convertible options, since these options are exercised without proof of insurability, and rates are based on age, gender, and policy period. Policy periods can range in years from 1 year, 5 years, 10 years, 20 years, 30 years, or up to age 65. Disadvantages of term insurance are: it does not build cash value, there's no loan or non-forfeiture values, or no living benefits. Premiums increase until premiums become prohibitive at the later ages, and there's no lifetime coverage. The term coverage may expire before the need does. And insurers do not normally issue term insurance when the insured is in poor health and considered a substandard risk. Let's now talk about whole life insurance. Whole life is also a permanent contract because it provides both a death benefit and cash accumulation or living benefits. The reason it's called whole life is because it provides permanent protection for the whole life of the customer, from the date of issue to the date of the insured's death, provided all the premiums are paid. The benefits are payable is the face amount of the policy, which remains constant throughout the policy's life. Premiums are set at the time of the policy issue, and they too remain level for the typical whole life policy. The purpose of a whole life policy was designed for those who want a lifetime death benefit, locking in the amount of the premium payment for life and to build cash. What distinguishes one whole life policy form from another is the method of payment, which is how whole life policies are identified. The most common method of payment is the continuous premium whole life policy, which is also known as straight life policy. Other names are pure and continuous whole life. The method of payment falls into two broad categories: continuous pay or limited pay. Though we will discuss the various whole life policies later in this section, here's a quick overview. Premium paying for life. Examples are straight whole life, referred to on the test as typical whole life, modified whole life, graded premium whole life, current assumption whole life, indeterminate premium whole life, indexed whole life, and adjustable life. Those all pay premiums for the life of the contract. Limited pay whole life can structure payments for a 10-year, 20-year, 30-year payment, and they still endow up to age 100. The insurer guarantees the premiums, death benefits, and the cash value. This is sometimes why whole life is called guaranteed contract life. Whole life has guaranteed cash values. Cash value is guaranteed to increase in increments, earning a minimum interest rate and a guarantee to equal the original death benefit at age 100. Since all whole life policies endow at age 100, in essence they could be called endowment to 100. Limited pay policies such as 20-year pay just become paid up in 20 years, but the death benefit remains in force till age 100. And the cash values continue to increase in increments so that the cash value equals the face amount at age 100 and the policy endows. And they all have level premiums. Premiums remain the same and are guaranteed for the life of the contract. The face value is a combination of the pure protection and the cash value bundled together. For test purposes, the death benefit will always be the original face amount. Pure insurance protection is the face amount minus the cash value. As the cash value increases, the amount of insurance protection decreases to meet the death benefit. Conceptually, a whole life policy consists of an element of decreasing term insurance and an increasing cash accumulation. In other words, the savings inside the life policy, the cash accumulation, is used to pay the death benefit. So if you have a $100,000 life policy and you've saved $50,000 within that policy and you die, they're going to use your $50,000 savings and then the life insurance company's $50,000 to pay for the $100,000 death claim. What needs are met and what are the advantages of whole life? The principal advantage is that it provides lifetime death benefit coverage and can be used in situations where insurance needs to be enforced no matter when the insured dies, such as estate conservation or estate planning. It provides protection for permanent needs, such as the cost of death, dying, and final burial expenses. The level premium enables the policyholder to know exactly what the cost of insurance will be and offers a form of forced savings. Whole life builds a living benefit through its guaranteed cash values, which enables the policy owner to use some of this cash for emergencies as a supplemental source of retirement income, college tuition, or for other needs or business needs. It guarantees the funds will be available whether an insured lives or dies, as long as the premiums are paid. Disadvantages of whole life are the premium payment period may last longer than the insured's income producing years, and though it provides the longest period of protection, it does not provide as much protection per premium dollar as term insurance. Various types of whole life insurance, the different types of policies are identified by the method of payment of the premium. The straight whole life, the majority of whole life policies are straight life, which means the premium payments are continued to age 100 or death, whichever occurs first. It's sometimes referred to as a continuous or pure whole life policy. Limited pay whole life allows the policy owner to pay for the entire policy over a specified period of time. Common forms of limited payment whole life are 20 pay whole life, which spreads premium over 20 years, or 30 pay whole life, or life paid up at age 65. These are all forms of limited pay whole life. All of these policies will mature or endow at age 100, but have shorter premium payment periods. They are designed for the policy owner that wants lifetime protection, but not lifetime premiums. Single premium whole life involves a large one-time only premium payment at the inception of the policy. Such policies have very substantial cash values and loan values immediately, and of course, the policy is fully paid up from inception date. Since the premium is being paid up at the beginning of the policy, there is a substantial discount. So this is the cheapest way to buy life insurance if you can afford to pay one large lump sum up front. Let's talk about modified whole life. It means there will be one premium increase, but still premium paying for life. The insured receives a discounted premium, usually for the first 5 years, of approximately 50%. The premium then increases to an amount slightly higher than a typical whole life policy to make up for the earlier discount in the first 5 years, and it still pays to age 100 or death. Let's talk about graded premium whole life. There will be more than one premium increase. Graded premium whole life discounts premiums in the early years and then increases annually for a specified period of time, then level premiums thereafter to age 100 or death. Premiums level out at higher than a typical modified whole life policy. Now comes indexed whole life. The policy face amount increases with increases in the consumer price index. If the policy owner assumed the risk for inflation, the insurance company would bill the policy owner each year for the new higher amount of insurance. Evidence of insurability was not required. If the policy owner declined 1 year to purchase the increase, no further automatic increases were permitted. Indeterminate premium whole life. This policy has a dual premium concept, a maximum premium, and discounts that may reduce the premium in the early years. Current assumption whole life. There are many variations of this policy. This policy is a hybrid of traditional cash value life insurance and universal life insurance. These policies are non-participating and have some after-the-fact adjustment mechanisms without actually creating an actual policy owner cash dividend or cash value. These products are sensitive not only to interest and investment performance on the underlying assets, but also the mortality and expense experience of the company. In other words, everything can change during the policy period. What type of needs are these used for? They're designed for individuals who need the discipline imposed by a fixed premium design, but want to participate, at least in part, in the positive investment returns beyond the guaranteed interest rate in the policy. Note that plans which modify premiums are generally designed for marketing purposes and to make life insurance more affordable and attractive to more buyers. Let's now talk about the flexible, non-traditional types of life policies. Flexible policies provide the opportunity to customize the policy for the needs and wants of the insured. The variable The variables provide a hedge against inflation. Premium flexibility enables policy owners to pay what they can when they can. This provides the opportunity to increase the cash value when the policy owner has the resources to do so. The universal and variable universal even allow for premium skipping. Let's talk about adjustable life. Adjustable life insurance offers a policy owner many options for adjusting the policy features and still remain a guaranteed contract. It is the only policy that the policy owner may raise or lower the face amount, change the premium, and change the length of protection or type of protection being provided. It provides term and whole life in a single policy and allows the policy owner to change term to whole life or whole life to term. Just like with any term or whole life policy, the premium requested must be paid and there is no skipping premium. Let's talk about a universal life, also known as flexible premium adjustable life. Universal life is a flexible premium adjustable death benefit life insurance contract that accumulates cash value. It's a very popular product due to its flexibility. A prime feature of universal life is premium flexibility. Premiums paid into a universal life policy accumulate and together with interest make up the policy's cash account. After sufficient cash value is accumulated, the policyholder has considerable flexibility with regard to the account. After sufficient cash value is accumulated, the policyholder could stop paying premiums or borrow from the cash value. The policyholder can choose a target premium, pay an extra money in a lump sum to increase the premiums, or even skip some premium payments. The policy owner may pay premiums in whatever amounts and at whatever time frames they want, and the policy will stay in force as long as the cash value is sufficient to pay the monthly expenses and mortality charges. Universal life is also flexible in that the death benefit is adjustable. The policy owner can raise and lower the death benefit to meet their needs. There is no reason to purchase another policy. However, to adjust the death benefit to a higher amount, proof of insurability would be required. What needs does a universal life policy meet? UL is indicated whenever the most flexible in life insurance is desired. Policy owners whose circumstances change can later adjust to their needs by changing their premium payments and/or death benefits. It's extremely popular in the family market today. A young parent with a growing family and modest income can purchase a universal life policy that's initially configured with low premiums and high death benefit to resemble a traditional renewable term policy. As the parent's income grows, premiums can be increased to build tax-sheltered cash within the policy. And later, when cash is needed, such as to pay for a child's education, premiums can be reduced or stopped altogether, and/or cash can be used to help pay for school expenses. Later, the policy owner can increase the premium to increase cash value to supplement retirement, and at retirement lower the death benefit if their needs have decreased. So universal lives are one of the most popular policies sold because of this extreme flexibility. Let's talk about loans and partial withdrawals. Just like with whole life policies, the policy owner has access to the cash value in a universal life through a policy loan. A feature that's unique to universal life is that access to the cash value can also be through a partial surrender. These withdrawals or partial surrenders can require a small service fee, however. All other life policies require full surrenders. A full surrender of a UL for its cash account would be subject to surrender charges during the first 15 years, some policies for 10 years. For test purposes, universal life and variable universal life are the only policies that the policy owner has flexible premium and can make withdrawals from. Flexible premium means the policy owner determines whether or not to make a premium payment that month and for what amount. There are various charts in your text that explain the relationship between premium, cash value, and death benefit, and you should study those charts to help clarify these concepts. What are the disadvantages of universal life? The very same component that creates its advantage, flexibility, is the disadvantage. The flexibility associated with premium payments can be a disadvantage since policy owners can too easily allow their policies to lapse. There is no forced savings feature since premium payments are not required as long as there's sufficient cash value to carry the policy. Let's now talk about indexed universal life. Instead of the insurance company declaring a specific interest rate or dividend, as with traditional life insurance, interest earnings are credited based on increases in the value of a specific equity index, such as the Standard & Poor's 500. Credited interest is linked to increases in the S&P index without the downside risk associated with investing directly in the stock market. These are permanent insurance policies that provide features which give you a sense of stability through a guaranteed minimum interest rate, tax-deferred interest accumulation, and access to cash values through withdrawal loan provisions. An indexed universal life policy gives the policyholder the opportunity to allocate cash value accounts to either a fixed account or an equity indexed account. Index policies offer a variety of popular indexes to choose from, such as the S&P 500 index or the NASDAQ 100. This allows the insured potential for greater cash value and maintain basic interest guarantees. Index policies allow policyholders to decide the percentage of their funds that they wish to allocate to a fixed or indexed portfolios. Also, these types of universal insurance policies typically guarantee the principal amount in the index portion, but cap the maximum return that a policyholder can receive in said account. The cap varies among the insurance companies and can range from 7% to 12%. Since these policies are seen as hybrid universal life insurance policies, they're usually not very expensive due to lack of management, and they're safer than the average variable universal life policy. However, the upside potential is also limited when compared to variable policies. A quick example of an indexed universal life tied to an S&P 500 index would be, let's say the index has a cap, your policy has a cap of 10% on it, and the S&P 500 index went up 15% last year. Well, the most you'll get is 10% interest. But let's say the index went negative 20%. Well, most of these policies have a floor of 0%. In other words, you would get zero interest that year, but your principal would not go negative. Let's now take a look at variable life and variable universal life policies. Variable life is also known as variable whole life and variable universal life. It was designed as a hedge against inflation. This is accomplished by establishing an investment account rather than a cash value account. The stock market usually has kept pace with inflation by increasing in value. The policy owner's premium purchases units. The policyholder funds are placed in separate accounts that are distinct and separate from the insurance company's general investment fund, also known as the general account. The policyholder may allocate, or they have a choice, of their premiums and cash values among several mutual fund type alternatives or sub-accounts with different investment objectives that typically include stock funds, bond funds, and money market funds. In other words, instead of the insurance company giving a guaranteed interest rate on the savings, the cash value is invested in mutual funds or bond funds or money market funds, and the policyholder enjoys the increasing value of those funds, but can also decrease below the original value. So there is market risk. The policy owner purchases units and assumes the risk of the separate account. Values vary daily based on the investment expenses of the underlying funds, and separate accounts are not commingled with the general account for the insurance company. To sell variable universal life and variable life requires that the agent also have a securities license, Series 6 and Series 63. Variable products come under the jurisdiction of both the Department of Insurance, DOI, and the Securities and Exchange Commission, SEC. Variable products require that you provide a prospectus and evaluate risk tolerance for the customer. Variable life is a fixed premium product, and variable universal life is a flexible premium product. There is no guaranteed minimum cash value in either a variable life or variable universal life. The cash value at any point in time is based on the market value of the assets in the separate account, meaning the mutual funds. This means that the policy owner bears all the investment risk in these types of policies. Yes, your cash value can go down if the securities and mutual funds in the account go down. So there's a chart in your book that explains this concept and lists the way, graphically, the way variable universal life policies work. So you should study that graph. In variable life, the death benefit may increase or decrease, but not below the guaranteed minimum amount, the original death benefit purchased. The death benefit increases based on a formula that relates the investment performance of the separate account to the face value or death benefit of the policy. What needs do variable life policies meet? It provides more opportunity for investment returns that may exceed the fixed returns under guaranteed contracts. Variable life offers this opportunity while still providing a guaranteed death benefit and a fixed premium. Variable universal life offers this opportunity of higher gains with a flexible premium and guarantee in death benefit. The guaranteed death benefit in a variable universal life is that the beneficiary will receive the original death benefit. However, the policy expires if there's insufficient funds to pay the mortality expense and expense fees. On the test, anytime the question refers to a product that's a hedge against inflation or provides a hedge during inflationary times, choose a variable product as the answer. Let's look at an endowment policy. An endowment policy is considered a permanent insurance contract that has the same structure and features as a whole life policy, the only difference being that the policy matures or endows earlier before age 100. An endowment contract has a level face amount, the death benefit, level premiums, and a declining amount of insurance protection as the cash increases until it equals the face amount or death benefit at the maturity date. This product was designed for policy owners who needed a specified amount of cash by a specified period of time. Again, there's a couple charts in your text that graphically explain how this works. You should study those. The purpose of an endowment contract, although it's considered life insurance, they were designed to have an emphasis on the cash value being the primary concern and the insurance being a secondary concern. Let's now study the common modes of premium payment. In life insurance, the term mode means the frequency, how often a premium is made to the insurance company. A life insurance company's policy rates are based on annual payment plan, so the company can invest the year's worth of premiums all at one time. If the insured decides not to pay the full year's worth of premium, he or she will be charged an additional fee because the company is not able to invest that full year's premium amount and loses the interest it could have earned. So if you pay monthly, you're going to pay a little bit more than the person who pays their annual premium all at once up front. The insured has the option to pay premiums on an annual, semi-annual, quarterly, or monthly basis. Most companies offer an automatic death benefit that will debit a checking account, savings account, or credit card on a scheduled basis, meaning an automatic draft plan that automatically drafts the money out of your account. The trend in the United States is that death rates have been falling and life expectancy has been increasing throughout the 20th and 21st century. The CSO, which stands for Commissioner's Standard Ordinary mortality tables, are periodically revised because longevity tends to make past data obsolete. It's for this very reason that the industry is now using the CSO 2001 mortality table, which extends to age 120 due to longer life expectancy. Even though the population is living longer and the mortality charge per 1,000 is less, the mortality charge still increases as the insured's age increases. The reason that whole life insurance works is the level premium concept. Level premium policies were developed because the mortality costs accelerated rapidly after middle age. The insurers developed the level premium concept to make it easier to buy life insurance, policies for which the premium remains the same throughout the policy period. Basically, it works by setting the premium at an amount which is more than the amount needed to cover the cost of mortality during the early policy years. This excess premium is then set aside and earns interest. Since the annual premium does not change in the later years of the policy, the premiums actually being paid will be less than the amount that would otherwise be necessary to cover the increased cost of mortality. At that time, the early overcharges plus the interest on those funds will be applied to cover the shortage of premium in the later years. Think of it as an average. Let's study the different types of policies based on how they collect the premium. The first is single premium. Instead of paying $1,000 per year for $100,000 life policy, a 30-year-old policyholder elects to pay a single premium. This single premium would not be $69,000, which would be his age 99 minus his current year of 30 years, leaving 69 years left, because the required premium is paid in advance and will be heavily discounted for many years of interest earnings. The actual premium to be charged would depend on the initial policy expenses and the actual interest to be earned on the funds which exceed the initial mortality charge. Single premium applies to policies with cash value and accumulation accounts. The single premium is the cheapest way to buy life insurance. Let's now talk about limited pay. Using the same example as a single premium, instead of paying $1,000 per year to age 100, a 30-year-old policy owner elects to purchase a life paid up at 65 policy. Once again, the premium would not be $69,000 because the premiums will be paid for a shorter period of time, 35 years instead of 69 years. Since the shorter the premium period, the higher the premium. With the premiums being paid in advance, the premium receives a discount for extra years of interest earnings. Term insurance cannot be paid up or cannot be a limited pay policy. Term insurance you pay each year for the entire term. Limited pay policies are commonly offered with 10, 15, 20, or 30 years or to a specified age, such as age 65, known as life paid up at 65 policies. The next type of policy is modified premium. Once again, using the above example, instead of paying $1,000 per year for 69 years, the policy owner who purchases at age 30 would pay a discounted premium, 50% discounted, usually for the first 5 years. Then the premium would increase to an amount higher than the $1,000 for the remaining 64 years. The increased amount is the makeup for the first 5-year discounted premiums. Then there's a level premium policy. Level premiums feature premium payments that are contractually guaranteed to remain the same, fixed, and are required to be paid throughout the policy period. All term policies are level premium. However, the level premium only applies during the current policy period. If a term policy is renewed, the new premium charge will be based on the insured's current age. In other words, if you have a 10-year term policy, the policy premium stays level for 10 years. But if it's a renewable term, it can be renewed in year 11 at a higher premium cost, and then renewed at 12 years at an even higher cost, and at 13 at a higher cost. In other words, the cost each year will go up as your attained age goes up. But it's level during the contract during the first 10, 20, or 30 years, depending on which type of policy you purchased. Let's now talk about fixed versus flexible life. Fixed premium has two meanings. Fixed can mean level, or fixed can mean the premiums are set in the contract and the policyholder must pay those amounts to keep the coverage in force. The fixed premium set in the contract shows the actual premium to be paid. In a modified contract, the increased premium amount will be shown. In a graded premium contract, the new premium to be charged each year will be listed, as will the level premium once the increases cease. Flexible premium also has two meanings. The most common meaning is that the insured is in control within limits of what they are paying. In the universal life or variable universal life, the insured can pay a minimum premium, a target premium, or extra premium. And after the policy's been in force for a while, they can even skip premiums. This is the definition that is most likely to be used on your test. The second meaning is that the premium can fluctuate. Let's now look at some special coverages. Specialized life insurance policies have been designed to apply to some of the more common situations where coverage is needed. Different types of coverage in a single policy are known as combination policies. Combination coverage packages are simply combinations of the basic policies we've already discussed with additional amounts of level or decreasing term added to them. In some cases, the added coverage applies to the same insured. In other cases, coverage may apply to other family members. A few specialized forms are policies that insure two or more people on the same policy for a single amount of insurance, such as a joint life or joint and survivorship life. One other type of special coverage is mortgage redemption policies. The mortgage redemption policy or rider is simply decreasing term insurance. The benefit amount of the term coverage is designed to be sufficient to pay off the unpaid balance of the mortgage loan at any point in time if the insured dies before paying off the loan. Insurers may issue a policy, or more commonly a rider, that insures all or selected members of a family in one contract, commonly known as the family protection, family policy, or the family rider. When issued as a policy, it provides whole life insurance on the father or mother, who's designated as the principal named insured, with a premium based on his or her age. Term insurance is then generally provided on the wife or spouse and children, or on the father and children if the wife is the principal named insured. Generally, family plans are sold or purchased with reference to units of coverage. A unit might equal $3,000 or any other amount specified by the insurance company. Thus, when the family plan is purchased, the policy schedule might show 4 units for $12,000 of whole life and the principal insured, and 2 units or $6,000 of level term for the spouse, and 1 unit of $3,000 of level term for each child currently alive or yet to be born. Children's riders are convertible to permanent insurance whole life without proof of insurability. The children's riders covers the child from 15 days up to age 18 or 21 to 25, mostly to 21 or 25 if the student's in college, and they are sold in units. Let's now talk about policies linked to indexes. The first index-linked policy was the index-linked whole life that was tied to the Consumer Price Index, the CPI. This policy was discussed previously in this section. Beginning around 1995, a new product was introduced known as equity index products. The most significant advantage of equity index life insurance is that as a combination, most of the features, benefits, and security of traditional life policies with the potential to earn interest based on the upward movement of an equity indexed. Today, equity index life can be whole or universal life. Instead of the insurance company declaring a specific interest rate or a dividend, as with traditional life, interest earnings are credited based on increases in value of the specific equity index, such as the Standard & Poor's 500. Credited interest is linked to increases in the S&P index without the downside risk associated with investing directly in the stock market. Another type of policies are juvenile policies, and some of them are called jumping juvenile. Individual policies written on the lives of children are known as juvenile policies. Ordinarily, they're written to cover children at least 15 days old to age 15. Application for insurance and ownership of the policy rests with an adult, such as a parent, guardian, or even a grandparent. The adult applicant is usually the premium payer as well until the child comes of age and is able to take over the premiums. And the payer benefit rider is usually attached to juvenile policies. It provides that in the event of death or disability of the adult premium payer, the premiums will be waived until the insured child reaches a specific age. A special form of juvenile insurance is the jumping juvenile. These policies are typically written on children up to age 15. The death benefit automatically increases at age 21 or 25 to as much as 5 times the original death benefit. There is no increase in premium, and proof of insurability is not required. Let's now talk about a return of premium policy. The ROP policy was designed to appeal to people shopping for affordable term life insurance who hate the idea of getting nothing back on their so-called investment if they do not die. Previously, the only other option was to consider a permanent policy that builds up cash value. Here's how an ROP policy works. Just like term life, you buy a policy for a set amount of time, say 30 years. You make your payments every year, and in the event that you pass away, your heirs are paid the face value or death benefit of your policy. Should you outlive your policy period, the insurance company sends you a tax-free check for the full amount that you've spent on premiums over the lifetime of the coverage. This type of policy, of course, is more expensive. Let's now look at the joint life or first to die policy. The typical life insurance contract is written on the life of one person and is technically known as single life insurance. A contract that can be written on more than one life, however, in which case is known as a joint life, also called a first to die policy. Strictly speaking, a joint life contract is one written on the lives of 2 or more persons and payable upon the death of the first person to die. Let's look at joint and survivorship life, or last to die. Joint and survivorship life, last to die, is a single policy written to insure 2 or more lives that pays the death benefit when the last person dies. Premiums based on a joint issue age, and usually the policy is less expensive than 2 separate policies. Face amounts are usually larger in these types of policies, normally starting at $1 million or more. And these are usually used for estate planning purposes. There's a chart in your text that shows the example of how these policies work, and I recommend you study those. Let's now talk about term insurance. There are many variations of term insurance which are identified by what happens to the death benefit during the policy period and what options are included. Level term. As the name implies, level term means that the death benefit remains level throughout the select term of the coverage. The policy period can be 5, 10, 20, or even 30 years. The premium will also remain level, fixed, during the specified policy period in most policies. Term policies may be issued with virtually any initial face amount. Various types of level premium term. Guaranteed level premium. Premiums are guaranteed to stay the same during the level premium period. Non-guaranteed level premium. The second type is the non-guaranteed premium level term, where the premiums are only guaranteed for a limited time period, such as 5 or 10 years. And the third one is indeterminate level premium. With this type of policy, the premium may fluctuate between the current charge and a maximum amount that's stated in the insurer's premium tables, which are based on the insurer's mortality experiences, and investment returns. And then there's renewable term. Term policies are either renewable or non-renewable. Renewable means for a small additional premium, the policyholder has the contractual right to continue the contract. If a policy is renewable, the policy owner may unconditionally renew the coverage for successive terms or to a specified age by paying this higher premium. Each time the policy renews, the policy premium will go up. Most renewable term policies are renewable to age 75, 85, and at some companies, age 95, and most insurers do not offer renewable term policies to new applicants after a certain age, typically between age 60 and 70. No forms must be signed and no proof of insurability is required. Only level term policies can be renewable. If the policy is non-renewable at the end of the term of coverage, the policy owner has no legal right to continue the insurance. This means the policy owner may apply for new insurance. If the insured's health has deteriorated, he or she may no longer be able to qualify for new coverage, or coverage may be obtainable only at a significantly higher premium rate. Let's now talk about convertible term. This is a very important option or feature that a policyholder should consider in purchasing term insurance. In return for slightly larger premium, to compensate the insurer for the extra work it's assuming, a convertible term gives the policy owner a contractual right to exchange the term policy for some form of permanent policy without having to prove insurability. The conversion feature is often attractive when a person's circumstances change and there's need for lifetime coverage. Conversion allows the policyholder to lock in the premiums, although at a higher premium rate than the current term policy rates, without having to prove insurability. Give you an example. Let's say you buy a 10-year term, and 9 years and 6 months into it, you develop colon cancer, and a doctor gives you 2 years or 3 years to live. Well, your term policy is going to expire in 6 months. If it's a convertible term, you can convert that policy without proof of insurability to a universal life or a whole life policy, and yes, pay a higher premium, but it will not expire and you will have insurance in force when you pass away and your family will get the money. So that's a huge benefit of term insurance. It can always be converted to a permanent plan of insurance without proof of insurability. Conversion is term to permanent, not term to term, and not permanent to term, meaning you can only convert a term policy to a permanent plan like universal life or whole life. You can't convert one term to another term, and you can't convert a permanent policy to a term policy. And conversions can be at the attained age or at original issue age. Some companies offer term conversions retaining your original issue age in the new permanent policy. Most term policies are issued renewable and or convertible. These options increase the cost of the policy, but the major advantage of these options are there's no new suicide or incontestability period, and there's no proof of insurability required. Another type of term is decreasing term. This is a form of term insurance where the policyholder selects an amount of initial coverage, then over a specified period of time, the death benefit declines steadily until it reaches zero at the end of the term. This decrease in face value may occur monthly or annually. Premiums are level and are payable for the duration of the coverage. Because the coverage is decreasing while the premium remains level, as the insured ages, each dollar outlay buys less insurance each year. Coverage is the highest when the coverage begins and decreases to zero by the time the coverage ends. Let's now talk about increasing term. Increasing term typically is only offered as a rider, as a low-cost add-on to other basic policies such as ordinary whole life or universal life, or as part of a package of policies. This type of coverage is commonly called return of premium benefit or a return of cash value benefit. The basic idea is that in the event of the insured's death, while the increasing term policy is in effect, the beneficiaries receive the entire face amount of the basic policy plus a return of the premiums paid or the cash value. Then there's re-entry term. Insurance companies can afford to charge relatively low premiums in the first few years after issue because they've had the opportunity to screen the applicants to select only those who are in good health. Insureds tend to remain in good health for the first few years after the policy is issued. However, over the years, the pattern is for some of the policyholders who are in the best health to drop the coverage, and for those for the worst health to continue their coverage. This is known as adverse selection, since the worst, most likely to die early risks remain, and the best, most likely to survive to older age risks, no longer support the pool of dollars available to pay claims because they've lapsed their policies. To help offset this trend, the insurance companies must build additional renewal premium charges into the policy in later years to cover the additional mortality costs associated with this adverse selection against the insurance company. If an individual is in good health, he or she can apply for new insurance coverage by showing evidence of insurability and once again lower the select mortality charges associated with new policy issues. Many insurance companies offer re-entry term policies, which are also called select and ultimate term policies. As long as the insured continues to show evidence of insurability at periodic intervals, the renewal premiums, which are based on the lower select mortality charges, remain comparable to the premiums for newly issued policies. That now concludes this section on life insurance. Now time to take your test tips.